Usually I have to try to explain what a company does in these videos. I don't think I'm going to have to do that with Coca-Cola. Coca-Cola is maybe one of the most widely known brands around the planet. They sell soda, clearly, right? But so we're mostly going to ignore that and just dive into the chart, kind of the strategy behind using this stock, right? So over the last year, 5 years, 30% all time. Whenever I look at any stock, I like to look at the chart to see, just the history of the price action on it. Has this been pumped and dumped before? Is this a growing company? How long has it been IPO'd? I've said been around before, and then I had someone saying I was lying to them in the video because even though PayPal IPO'd in 2015, they had been around before that. Yes, I know. Companies usually don't start up and go public immediately. I don't know if that ever happens. But anyways, that's beyond the point. So Coca-Cola is a long-term company. Long-term outlook. Of course, it's a long-term company, but how do you play the stock? Personally, I see it as a value play and a dividend play. This dividend of 2.8% is good, right? It's not as attractive this second with rates, right? You can get CDs significantly above that. Your money's locked up for long term, but you don't have the risk of a market downturn, although relatively speaking, Coca-Cola's not going to absolutely tank with a market. It's not like a risky tech stock, right? It's not going to just lose half of its value or 2/3 of its value because money is more expensive to borrow or something like that. But what I'm looking at, right, with this stock is a value play, although the PE, relatively speaking, isn't super cheap for a value stock. It sits around the S&P 500 average, although it has been a super consistent stock throughout the year, so I guess it shouldn't be super surprising. But there is even a decent amount of tech stocks that you can get cheaper than this. Qualcomm, for example, trades at PEs lower. STM, I'm going to talk about. They're a European stock. They trade lower than this, and they're growing, and they've performed better than this. However, in a dividend portfolio, I think Coca-Cola is attractive at this range, certainly. So we look at that 2.8%, which isn't crazy, but the PE is towards the high end of what it will be. I don't want to say ever, but it's not. This is probably the low range you're getting. You can probably expect somewhere between 2.6 and 3.3 of the dividend going forward. So that's definitely fine for a dividend stock that's aiming to do a number of things. Whenever I look at a dividend portfolio or a dividend, when I'm trying to compile stocks into a dividend portfolio, I like one of two things. Companies that are going to pay a dividend somewhere between 2.5% and 4%, 4.5% maybe, while matching inflation or preferably beating inflation. That lets you take that dividend as a form of income, do whatever you want with it, while not having to worry about inflation. For example, if you're just getting the dividend, 2.5% over the course of 20 years, let's just say 4% over the course of 20 years, all of a sudden the 4% on that yield is going to be less than it was because of inflation. With a stock like Coca-Cola, if we zoom out to the all-time, this is the only time I can find where if you bought it, you would be significantly underperforming inflation, even if you bought it, for example, in 2029 or 2019, before inflation went up dramatically. This is one of the biggest inflationary periods in U.S. history. It's up 23%. Oops, wrong tab. And Coca-Cola has still significantly beat it while paying out this dividend the entire time. Like I said, maybe I'm wrong, but I think this is about the only time. If you bought it in the 40s in 1998, you would have significantly underperformed, with the stock rising 75%, while inflation has risen 93%. But even then, you still would have had many years where you're getting near, to be fair, I'm not going to speak for the dividend it paid during the entire time, but I would assume it paid, if we're assuming it paid roughly the same dividend during that time period, even a bit less, you still would have clearly came out on top, even if you bought it at the very worst time in 1998. So this is a stock that I would look for in a portfolio I wanted to match or beat inflation while paying a decent dividend. Now, there's the other type of dividend portfolio I like is one where you're not necessarily trying to beat inflation, but you're trying to get a very high yield of around 5, 6, 7%, which is doable, but you would have to leave some of that extra to combat inflation, preferably. Obviously, you can do whatever you want in your portfolio's dividend or not, but personally for me, those are the two that make sense in my head and that I would ever consider. So, let's dive into some risks. There's not a whole lot of risks for Coca-Cola. Clearly, they have a great brand name. They've a long track record of succeeding, all the way back to at least the 1980s. I mean, significantly before then, but I try not to look too much past then because it's so long ago that we're talking 40 years at this point. So really not even too important to look at all the numbers for that. It's too far ago, too long ago. World's so different. But some risks I would factor in is Ozempic and the people's appetites going down. Now, I don't think it's going to be a huge deal. I still think people are going to need to eat clearly. People like soda. That's never going to go away. But you could, if you're being very bearish or you're trying to take, if you're trying to look at it from the most scrutiny possible, you could say maybe appetites are going to significantly fall. And I know appetite and thirst are a bit different, but let's just play devil's advocate. However, I view it is less of an issue. I don't necessarily see eye to eye with that. I think people are always going to want sweet tasting drinks, maybe sugar contents drop, but Coca-Cola has enough money and enough capital and enough investment that they often can buy up competitors along with Pepsi or new brands that come up, things like that. So I'm not necessarily worried about their dominance in that. But I guess that is a negative in the sense of there is going to be competition, at least against Pepsi. I believe the brand of Dr. Pepper is doing significant. They're doing well as well, but clearly Pepsi is the large competitor to Coca-Cola. So it's not like a TSM scenario, very different company, but TSM currently they're just in a great spot because they are in a super important field and they don't really have any competitors, at least none that are making any money. Those are some risks. Clearly some advantages, long-term success, at least decent leadership they've been able to execute. They have a track record of, they pay a good dividend. Like I said, unless you timed it at literally the worst possible spot in 1998. Did I do 8? Yeah, I did in 98, not 99. You would be doing fine. Like I said, I kind of did it in the risks, but they have a large amount of capital where they can buy up brands, new emerging brands, things like that. 300 billion market cap if we look at similar ones. They don't even really have, I don't believe, monsters there, but they don't even really have any competition except for Pepsi anywhere near them. I usually don't look too much into all of the numbers and stuff, but yeah, they don't have any meaningful, they have plenty of assets. I mean, significantly outweighs debt, more than double. All right, let's look at some analysts and all that. Schwab thinks it'll be a C, which sounds bad, but that is the average stock in the stock market and the average stock in the stock market. Certainly S&P 500, I believe they do all stocks, but they're expecting just share price to do average, so somewhere around 6, 7, 8%. I don't know exactly how they think the market's going to perform over the next year, but they think it's going to be an average stock for the stock price and considering the dividend it pays, that's actually a pretty good rating. Morningstar gives it a 2 stars, economic moat wide. I hate the 0.3 rating they have here, but I would agree it's more wide than narrow. Probably I'd give it an 8 or a 9 for their market, that is, right? Buy, neutral, buy. Good ESG rating, which is interesting because I'm not exactly sure how all this works because they're given all 6s and then 8.7. Not really my problem. Let's take a look at some analysts on Yahoo. Oops, wrong tab. Dang, I can't hit it. The website is malfunctioning on me. There we go. Ah, dang, it keeps... Bruh, I can't even. It's embarrassing. There we go. If you're wondering why that happened and you made it this far, it's not because I'm an idiot. It's because I literally can't see. I have something going on with my computer screen, with my laptop. But anyways, right now, basically the last couple months, people were saying buy. Right now it's at hold. I'm not sure. It's towards the middle of the month, but I don't really see why you can... What changed from last month to this month? Did it run up significantly? I don't even really think so. Let's look at the 3-month chart. It's up 10%. Yeah, I understand that. That makes sense. But no one's really saying sell. And if you hold Coca-Cola, you know what it's about, and you're probably long-term holding anyways. I guess briefly, beat. Very not substantial beat, but it is a beat. So price target's a little bit higher than where it's at. Anyways, I like Coca-Cola. I like it in a dividend portfolio, trying to beat inflation. Historically, it will do that. Consistently, it will do that. It's a decent company. You're not going to make $1 bajillion off it. It's not going to moon like NVIDIA or TSM, right? It's just not. But you can perform very well in the stock. So anyways, that's all I have for this video. If you made it this far in the video, I'd appreciate if you left a like or subscribed or a comment. That's all I really got for you guys today. So I'll catch you guys in the next video. See ya.